when I talk to authors who've written a book and if their book happens to be on there, they're like, come on. They're like, are you doing that thing like when your great grandmother comes over and you just
Yeah,
put
you
my
put the
book on the
book up.
shelf? Come on. All right. Well, I think we've got a pretty good group of people and a lot of familiar faces. So I think we should get started. And people keep filing in as usual, so we can kick it off. So I like to start by just kind of welcoming everybody, and it's been nice to see so many familiar faces show up again and again. But I want to give you, for those of you who are new to tonight's session, I want to give you a little bit of context for what we're doing. So I'm DK, and you can see Mishti up there in the corner, and we're both from the Highlighter team. And we, along with a broader group of people, collaborate to build the Highlighter tool as a place to gather, to read, and discuss writing. And we've been very focused on traditionally published authors. And just recently, we started to expand to people who've written kind of deeper thinking in newsletters or blog formats too. And that's been really fun. And so the town halls are a way for us to bring writers into the mix, and we get to jam with the writer on kind of a deeper thinking piece. And it also helps us kind of get more context and gives us places to come together to read. So we've got this 4-part series on venture capital from Nikhil, which itself maybe would constitute a book, or maybe someday will turn into a book. You never know. As we've learned, sometimes blog posts are the on-ramp to the traditional publishing industry. So watch for this.
That would be awesome. Yeah, and there's so many reasons to be excited for this, but I think one thing that was really exciting to me when I was reading this is like your series kind of takes us through the state of VC today as someone who himself is in this transitory moment and kind of figuring out your own place in this landscape and how to best engage with it. So a lot of things coming together in a very salient way, and I'm sure we're going to have lots of awesome questions. So thanks for coming.
Now I'll give a quick note on format. So the magic of the town hall is when we keep it participatory. So please do chime in if you have ideas and questions. Probably the easiest way is pop over to the Zoom chat and you can ask a question or kind of mention a topic that's on your mind. And we'll sort of curate from there to invite people up to ask Nikhil directly or to participate in the discussion live. But don't feel like you have to, don't feel like you have to have too much prepped. It's really just meant to be fun, and we'll hang out and learn a lot together. I do see tons of familiar faces, so I'm sure that plenty of people who know Nikhil can chime in and grill him with your hardest questions.
Yeah, so please chime in. And in the spirit of getting everyone involved, I have a question for you to chime in on, chat with, which DK and I thought very hard about, which is basically, if you were putting together a fantasy VC sports team, which solo capitalist would be your number one draft pick? Put those in chat. I want to see it.
So everybody in attendance, go ahead and use the chat. We're not asking Nikhil that question. He doesn't have to pick favorites, but you do.
And while you're doing that, let's get Katie Stanton up, who herself has experienced this journey from operator to angel to now running her own venture firm. Up to intro, Nikhil.
Thank you so much, Mishti and DK, for having me and giving me this incredible honor. And I'm honored for a number of reasons. One, I'm an angel investor and highlighter, so I'm a big fan of DK and the team, and this is a wonderful product. And I'm also just a huge fan of Nikhil's. So a little bit of background about Nikhil. He's a graduate of Menlo School, where my son also went, and Princeton. And he's a founder of Artsy, and he's been this entrepreneur from a very early age. And he also has the most amazing investment experience. He's an investor in Tandem, Class Dojo, Lattice, Farmer's Dog, Tonal, Tally, and Perfect Foods. And we had the opportunity to meet as co-investors in Literati, another book platform, and also Color, a health tech company, and an undisclosed company that will come out later. And after about 8 years at Shasta Ventures, he was there for a number of years and was a managing director. And as you know, many of you know that he recently left. And now he can spend all this amazing time investing in a bunch of other companies. And he's the author of the hottest Substack newsletter, The Next Big Thing. And I think the 3 biggest reveals of 2020 will be Who will Biden pick as his VP? Will America get its shit together? And what is the next big thing for Nikhil? And so what you may not know, I was trying to think of some fun facts. His grandmother met Einstein, and his great grandfather served as India's ambassador to the US from 1952 to 1958. And I asked Tara for some dirt about him because surely, like, there's something juicy. And she couldn't come up with anything. Maybe I didn't give her enough time, but I can vouch that Nikhil is as awesome as you imagine him to be. And it is truly an honor. I'm so grateful to have gotten to know him over these years and really, proud to be here today. So welcome, Nikhil.
Thanks, Katie. That was very sweet.
Yeah, such a great intro. Thank you for sharing that, Katie. All right, so I'll kick it off with a couple of questions, but I also want to just remind everybody, feel free to chime in the chat. Super fun. So, one of the things that we like to start with is to understand a bit about kind of your writing process and some of your goals with your writing. So, I think over the years you've written pieces and you've been part of a larger venture firm, and now that you're sort of striking out to figure out what's next, you sort of coinciding with that, you have this major newsletter that's super hot and is getting all this attention. And I wonder sort of how you think about how the newsletter fits into your future. Is it an extension of what you've been doing in the past? And how does your process of writing work?
Yeah. So first of all, thanks so much for having me, and awesome to be here with so many friends and family and people I admire. So I'm excited to just hear what people's questions are and to have a really interactive discussion on all this. On my writing style and the purpose for writing, I think the main thing for me during the shelter-in-place time was to figure out, how to build good habits, and writing is one of those things that I've gone in and out of over the years, but I've never kept a real habit of it. And so I actually just started trying to write something every day as a first step. And this was probably in April. And then I found myself, enjoying that process. So I thought, okay, I should try to turn this into something that's readable. Undisclosed fact about me is in my Medium, I probably have 38 different drafts of posts that are sitting there over the years. And I just struggled with how to actually get those out there because there's just pressure around having them be really good and sort of perfect. And so there's a lot of stuff that I've been thinking about and that I've been writing about, but that I've never published. And I just decided, you know what, I've got to do it this time. I've just got to bite the bullet and publish stuff. And of course, I'd seen others take to Substack and the newsletter format as a way to just share more frequently. So that's what led me to start to do this. And my purpose was just get my ideas out there, become more intelligent from writing and from getting feedback on what I'm writing. And that was the genesis of the newsletter. As far as my process goes today, I still try to write something, daily. I'm not quite there. It's like every other day, and it really ramps up in sort of the Sunday, Monday, Tuesday timeframe before I'm posting something on Wednesday. And I'm happy to talk more about process stuff if people are interested as well.
Yeah, is that when you say you do something every day, would that be some of those drafts into Medium, or do you actually try to get something kind of out in either a Substack or tweet or?
Sorry, so this was prior, where I'd done this Medium drafting for many years now. I probably started that in 2014 or 13. Today, I have in Notion a number of different pages. Hopefully each one leads to a post at some point, but I don't think that's going to, a Substack post, but I don't think that's going to be the case. But within each of those are, different links that I found related to the subject, initial drafts of, hey, this is what sort of the outline might be for a post, and different ideas related to it are all sitting in those pages.
Right. I've heard from a lot of people who've had some success in writing that there's this benefit to just consistency and a little bit of like a grind, and then they get like almost surprised when something actually works to the extent that kind of some of the stuff that you've written recently has really worked. I wonder, did it feel like a surprise to you, or did you kind of know that these ones were real knocked out of the park type pieces?
You know, I knew that I could start to talk about my thoughts on venture capital more easily once I was out of Shasta, because something I learned in my AP US history class, a maxim, where you stand depends on where you sit. And so, you know, when you sit nowhere, when you're untethered, suddenly you can talk about things without, you know, being biased. And so I kind of had a sense, like, this solo capitalist thing. A lot of people are talking about it, but no one's writing about it. The characterization of the industry with agglomerators and specialists is something I've been talking about in private for a long time, as LPs of mine, like Laura, will attest to. But again, no one had published it. And I think partially it's because where you stand depends on where you sit, and it's just hard to talk about the industry when you sit somewhere.
Cool. I think we have a question from Laura. Laura, did you want to unmute?
Yeah, I'll kick us off. First of all, thank you for the articles. They were just so well done and really impressive. And one thing I've been thinking about is we have just all this cash in the ecosystem, and then all these moving pieces with specialists, soloists, like mega funds. Are there any holes in the market? Are there any possible holes left, or what's missing? And be curious about your view, Nikhil, and then also others.
Yeah, I'll try to kick it off. I mean, I think if you come up with an answer around holes, you know, it's very difficult, right? Like, it's very difficult to really say with conviction there's a hole in the market in this place. I do think, for instance, you know, between seed and the sort of product market fit Series A or Series B, there's kind of always been a little bit of a gap. And people, you know, you could think about it as seed extension, seed plus, post seed, pre-Series A. So I've always felt there's a little bit of a window there, and the chance to believe in something a little bit before folks who traditionally invest at the Series A or B believe in it when there are signs of product market fit in the company. But and maybe at the pre-seed, you know, maybe at the incubation stage as well, you know, there's a few great practitioners like Atomic, but maybe they deserve to be more at sort of the true idea stage. I'm curious what other people think.
Anybody have thoughts on that? I wonder you know, I feel like a lot of the gaps end up becoming emergent or obvious when you're sort of in the game doing something, almost like even if you're doing something that feels like it's not a gap, it's almost through that practice that you discover what the gaps are, sort of start, you know, you've got your ear close to the tracks and your spidey sense starts to kind of tune you into something.
It's interesting. I mean, even you could argue, you know, maybe the IPO is the gap, hence the SPAC trend that we're seeing right now.
Yeah, actually, it's an interesting topic that we're curious about. I think we were trading notes on your highlighter page about this. But do you think that the SPAC stuff is kind of an extension or kind of more relevant to the kind of solo capitalist, or is it part of the kind of agglomerator trend? Because I think right now, maybe some of the two more famous ones I can think of are, you know, obviously Chamath from, I think, 2017. And then I think Kevin Hart's just in the last couple of weeks has become more public.
Yeah.
That it's sort of like an individual brand is kind of leading those, even though there's a bunch of other, you know, ecosystem people involved. So is that a separate solo capitalist area to look at, kind of stage-wise separate?
Yeah, I mean, it's fascinating. I think, first of all, Chamath is like a solo capitalist and an agglomerator and doing SPACs. So I don't know where to put him on any map.
Bitcoin
And
investor,
he would not
yeah.
want to be on any map in any place anyway.
Right.
But I think you're right. There's a sort of democratization of the IPO through SPACs, and that means a lot of people are going to play there. And I'm sure that a number of venture firms are going to, a number of the agglomerators, maybe even specialists, are going to go. You're already seeing Ribbit, for instance, a fintech specialist firm. I don't know if they've raised it or apparently raising a Slack. I find it fascinating how there's so much talk about the IPO on venture Twitter. I don't know if people saw, the folks at Benchmark and the folks at Andreessen Horowitz going back and forth on this the other day. So we're definitely going to see more there.
And it might be starting as a individual phenomenon, but it sounds like you believe the agglomerators are all going to end up having, almost the way that everybody had growth funds, that this would just be a natural other type of vehicle that would sort of extend the stack.
Yeah, I think so. I don't know. What do other people think about this? Laura, have you seen any of this? Or
I'll chime in.
Yeah, please.
I wonder, I haven't actually seen this at all, but I'm wondering why this doesn't exist more, where you have a sort of more senior seasoned person pairing up with someone super young and hungry and junior and getting started to kind of start things together. And I worked at Open Door for several years, and Keith was a little bit of this because he was sort of pulling together the group of founders and was very involved, especially early on, in the direction of the product and helping figure out capital markets, like really important things to the business, but you don't see it very often. And it almost feels like you see it less. I think it's interesting, Nikhil, you brought up the atomic thing and that model. I think that's related but separate. And I'm just wondering, I don't know if we're going to start seeing this more. I actually had this woman reach out to me the other day. She's 19, lives in Canada, isn't going to college, in person. And she's like, I'm so bored. Do you need help with anything? And I'm like, probably, yeah, why don't we jam on some ideas? And I just want to be like, you want me to help you start a company? Let's do this together.
Mm-hmm.
And I wonder, is there a model for that? What would the equity setup look like? Or is it more of a mentoring thing and you're chairing things a little bit more? Anyway, I just think that could be an interesting trend in space.
Yeah, that's an interesting one. I haven't heard a lot of motion on that, but there's a handful of key places where that does seem to emerge. I think Keith is obviously one with Open Door, but I think he's also been on record as incubating a few other things in a similar way, even though they haven't, I think, necessarily. I don't know that any of them have been announced yet. But I think that as a trend, and I think if you go back to, I don't want to characterize the relationship too much, but I think the kind of Jim Barksdale, Mark Andreessen relationship had some undertones of that, even back from the mid '90s.
That's a great example.
It certainly does exist, but there's people who have kind of network and can help a brand new entrepreneur in some ways. It seems like we should see more of that.
Yeah, I think it's a really, really interesting topic. And hello, hey guys, I'm George.
Hey George.
Also back. fellow Princeton alum. Nikhil, I saw that was on your cover photo on LinkedIn. So shout out to Princeton Tigers. I think it's super interesting. I think that exists in the Valley, but in very, very sort of anecdotal cases, one-off cases, right? For example, Max Levchin, one of the just singularly smartest folks in the Valley, has HVF, hard valuable fund, and he ends up doing that with entrepreneurs. I think on a one-off basis. James Courier and NFX, they used to have an academy, and they used to do that on, I guess, not on a one-off basis, but with classes. And I've always thought about that to be an interesting model. Obviously, Atomic with their entrepreneurs that they essentially co-found companies with. But I think to a certain extent, you require a relationship that's very personal and very specialized. What I mean by that is these people almost become mentors, right? And I think it's hard to systematically pair mentors with mentees. It's a very personal relationship, like dating, right? It's hard to systematically, maybe in this day and age, there is a way to do that, systematically pair like people who would end up being great dates and great husband and wives. But that seems like that always ends up being a process with a very personal touch. And that's why I think it's been hard to scale across many different people and many different sort of firms or mentors in the Valley.
Yeah, that's a great point. Aga, do you want to jump in? Your question is kind of in this realm as well. Are you there, Aga? I can read your question out too. All right. I'm just going to read it out. She basically said, would love to hear Nikhil's take on the rise of venture studio funds, such as Entrepreneur First and Antler, and whether they will yield more successful startups.
Yeah, I mean, I think all of this is a really interesting trend. And I'm glad, Julia, that you brought this up. And maybe this is the place, like, we all in venture are trying to figure out how to bet earlier and bet on something before other people. And so the purest manifestation of that is to bet on a person without anything, without even an idea. Another person who's done this a number of times is Shanna Fisher out in New York. I actually spoke, for instance, to a current, someone who just graduated from college who got a job as a PM at one of Shanna's companies and called Shanna for advice. And Shanna turned around and said, why don't you take $200,000 from me and go start something and I'll help you. And I'll take 20% of it. And so pretty interesting model. And I think what's unique about, if you think about it in the find, decide, win, help, exit flowchart from the fourth essay, what's interesting about the studio model is the find piece is proprietary, right? And so, if you're coming up with the idea and if you're just betting on the person, you're sort of coming up with the idea together with that person, you have proprietary access to that idea and you can get ownership before other people. And so that's what's compelling about it. The question is, how do you decide on the person and how do you believe so strongly in that person that you're willing to bet on them at that earlier stage. I think there's also a little bit of, I always like to find a company where I feel it's the founder's life's work to make that company a reality. And if the idea was born out of a studio, out of maybe someone with the idea giving it to someone else who works on it, that's just not going to likely be true. And I've struggled with that with some of the studio-backed companies. So I'd say that's sort of the downside, and perhaps the issue with the model.
Yeah, it feels like the ultra boutique version of it is more likely to work than the kind of portfolio approach for this particular type of thing.
Yeah, but I think, if you talk to Atomic, what's fascinating is that they've focused just on this. And so they're doing a good job, I think, partially because they only do the studio model. And they feel the key decision is who comes in as CEO. And so they give a lot of equity away to that person that they bring in as CEO. And they view it as like the best CEO jobs in the Valley will be at Atomic companies because you get whatever 10% of the company pretty early, but the idea is already there. There's already a team. There's already some semblance of a product. And so they're trying to win from an access standpoint, not and from a find standpoint. I should have added this, not just on the proprietary idea front, but on the get the best possible CEO front too.
Yeah.
So then
on the flowchart, actually, I thought there was a really interesting point you were going back and forth with Hunter on Twitter saying like the execution of this cycle is often not consistent with a firm's strategy and brand. And I was wondering if you could talk more about that. Like, what blinds people to this? What are examples where it might go wrong? Like, how do you think about that fit?
Really great question. I'd love for others to chime in on this too. I think the quick thinking on this point is, you know, you have to fit, as Hunter said, you know, where you're finding companies, how you're finding companies, to you know, if you're a stage specialist or a sector specialist, that particular specialization. And if you're an agglomerator, you know, you sort of, if you're doing everything from a sector standpoint, from a stage standpoint, then you need to figure out how are you going to see everything. And I witnessed this when I was at Insight, where we basically, the mandate was to see everything as a firm. And if you look at the other agglomerator firms, they really want to see every company at every stage. And so, you know, most of them have to have an army of people to do that. They're all trying to build technology to do that and other things. And so the challenge can become, you know, number one, if the personnel you have on the team, you know, don't match, so the find, decide, win, help, exit buckets related to your strategy. And number two, if you have strategic, you know, drift, or you don't have a clear strategy, then it becomes very difficult to do the find, decide, win, help, exit stuff really well. So I don't know if that makes sense to people, but that's how I conceptualize it. Would love others' feedback.
Hey, Nikhil, I had kind of a thought is with your idea of these agglomerators, like all of these funds are so big, and for them to keep growing with their operations team, and as you noted, armies of 50 plus analysts, the fund size needs to keep growing. And that's what's happened to venture over the past 10 years. And I think some of these firms are turning into almost, you know, the private equity Blackstone style, where they're very top heavy. And so how do you see the ecosystem going forward in terms of how much capital can actually be sustained in the asset class?
Yeah, I mean, well, you're right, first of all, and that's why these firms are getting bigger and bigger. I think the good news is that venture capital is still a tiny fraction of even the private equity bucket, which is you know, still a fraction of the overall capital markets. But at some point, you know, something has to give, and so the industry can't just, you know, continue to grow forever, unless of course you believe that outcomes are just going to continue to grow and grow and grow, which, by the way, we have seen over the last 10 years to justify the growth in fund sizes. I don't know if any of the LPs like Craig or Laura or Nate or others have thoughts on this.
I mean, I'll chime in. I think it's a great question and something we wonder about given these fund sizes. You know, to be transparent, we kind of underwrite our Series A funds to 3x. And if you use the ownership after dilution, these are some really big outcomes. And kind of to Nikhil's point, there have been bigger outcomes. So you can kind of craft a story around that, especially if a firm has, if you go back to Nikhil's, you know, flow chart is seeing things and picking things and winning things. But yeah, I do kind of wonder about what returns are going to look like kind of within these great firms.
And Aaron, we've already seen, as I tried to point out in one of the pieces in the agglomerator specialist piece, that firms, you know, have gotten too big and have had to contract and become a specialist. The example I gave was Kleiner, and I think, you know, it looks right now like that's going to be a successful move from an agglomerated strategy where they had early and growth and separate teams to now just being early focused. But that's a very painful thing to have to go through. So that's just one other thing to think about.
They also seem to do it while in the midst of a personnel transition that was pretty substantial. So as I was kind of commenting on the highlight I wrote, that it's kind of a new team and kind of new strategy. And so you have kind of the brand maybe in the LP relationships, but otherwise it's a little bit maybe more like a reinvention than kind of as much of a navigation. I'm wondering if people are there examples of people who have, you know, successfully navigated down kind of to smaller scale things from kind of an existing structure, or are there too much cultural baggage or too much, otherwise, expectations set to make that work? So I think it's a really natural path for people to grow up, right? But it's maybe a harder path, and oftentimes it's probably super valuable to be able to grow down, to be more focused and get sharp that way.
Well, the other example is, Benchmark had a Europe fund, Israel fund, and refocused just on the US and spun out those funds. So they were able to successfully do it without leadership changes in their case, but because it was an international strategy that they pulled back. But otherwise, I think it takes decades to sort of to revitalize a firm in a bunch of cases. I think like Mayfield is an interesting example of a firm that was sort of at its peak in the 90s at some point, and then went through a lot of challenges, and maybe now is trying to reemerge from them many, many years later.
Right. Do you see a lot of people who are, I guess, you've identified a bunch of trends and how like kind of the pack is moving, let's say. Do you see people who move sort of antithetical to that pack, or do you see people, while everybody's zigging, they choose to zag?
That's a good question. I think there are firms like Union Square Ventures that certainly, if they wanted to, could raise, bigger and bigger early stage focused funds, but they still have early stage funds that are in the sort of $200 million zone or $150 to $200 million zone. If you compare and contrast to consumer focused funds, Maveron and Forerunner has gone up quite considerably in fund size, with their latest fund being, I think, $500 million. Maveron has stayed at like a sub $200 million fund size now for a while. And they actually went and did try to scale and decided not to, and ended up sort of pulling back. So there's an example for every one of these things. And I'm not the best venture historian. Probably someone else is better than me. Yeah.
I have a small scale example to relate. I think it was public that SV Angel used to be kind of more of an angel thing, and then it turned into a bit more of like an LP backed entity. And I think they sort of slimmed it down to they never got really big. They sort of purposely were always kind of at the seed stage, but they've become back more to angel style instead of even like a seed.
I think other questions that we should try to answer, because there's been a bunch of stuff.
Yeah, there's a lot coming in.
Had a good one. Do you want to jump in?
Hi.
Hi, Candice.
Hi, how you doing? Nice to see you guys.
Nice to see you too.
Nikhil, nice to meet you. So my question, I'm sitting outside of the Valley right now, as you can see, in Ontario, Halliburton, Ontario, at a cottage. But I'm really interested in your thoughts on geography and the network effects of venture, and whether or not you think we'll see more outside of the Valley in the future, especially based on, what's happening in the US right now.
Yeah, it's a great question. And I'm a bit jealous that you're in a cottage up in Ontario right now. Yeah, even more jealous now. That looks lovely. I think look, we've already seen for the last 10, 20 years how great companies can be built anywhere. And now what we've seen just in the last 4 months is that companies don't even have to be based anywhere at all. They can just be remote. And
totally.
And so, and then we've also seen, I tweeted about this, I think yesterday, but a fund like Blackbird in Australia, has a greater than 10x early stage fund. And so we're seeing, great performance from managers across the world. And so I think the answer to your question is sort of like, yes, like, we can see great firms be built anywhere. I'm sure we're going to see fully remote firms as well be successful and perhaps develop interesting processes being fully remote. that helps them again find and decide on companies in a differentiated way. So I definitely believe in that for the next, my whole career.
Thank you.
I had a similar question around solo capitalists. I was just curious about
Hi,
your
Ayush.
thoughts. Hey, David,
Hey,
how are you
welcome.
doing? Yeah, it's glad. I mean, it's 6 a.m. here. I'm yet to hit the bed. Crazy timings, but yeah, it's glad to be here. Nikhil, I of course been following your newsletters and some lovely thoughts. I was just curious. I'm actually quite fascinated about the rolling venture fund, right? I think AngelList can pretty quickly become one of the largest funds in terms of the amount of money which they and via angels, and that really increases the access to capital to young founders. And I was just curious that right now seed stage investing is being disrupted via that model, and it's beautiful, like the way they have done it. But I was curious about how do you see this evolving in future? Do you think this is gonna the fund sizes of rolling venture funds is going to become larger? And do you think that angels can part-time invest larger checks or lead 10 to 15 million Series A or B rounds as well?
Great question. And first of all, thanks for joining at 6 a.m. I wish I was as lucid as you at 6 a.m. For those of you who haven't followed this, AngelList has a new model called rolling funds. And the model enables people as LPs to commit to investing in venture funds on a rolling basis, on a quarterly basis. So you can commit to investing $200,000, let's say, over 8 quarters, and dividing that up into $25,000 commits for each quarter for the next 8 quarters. And it's a really interesting model, and I think it's going, and I'm very curious to get the LP perspective on this one as well. So a couple things about it. One, we have just started to see people actually raise capital using it. So it's extremely early. Sort of the first big announcement related to this is Sahil Lavingia, the Gumroad founder, has a new fund with AngelList rolling funds, and he has over $1 million per quarter now to invest in companies out of that fund. I've spoken to the AngelList team about this, and we're going to see some other really interesting test cases with bigger funds try to get raised on AngelList's rolling fund platform, where they'll be simultaneously trying to raise on AngelList through rolling funds as well as from institutional LPs. I think the model is going to change some of the math around venture. It's like, IRR gets calculated a little bit differently. I don't actually want to get into this because I think we're going to go down a rabbit hole, but actually let me try to get into it a tiny bit, which is, when you raise a traditional fund, you request capital from your LPs. You do these capital calls when you want to do them. And so, if you have an upcoming investment, you don't have enough cash to fund that investment, you do a capital call. And your IRR, the rate of return on your fund is calculated based on those cash flows in and cash flows out. With the AngelList rolling fund model, capital just gets committed every quarter, and you actually just get that in your account. And so it's going to change some of the math. I don't know if that makes sense to people, but it's going to change some of the math around how these things get calculated. But the broader thing that's so interesting is that a lot of people can now be LPs in venture funds using the rolling fund concept. There's SEC rules around the accreditation level that you have to be as an investor, and how many accredited versus non-accredited investors you can have in a fund. But it's really democratizing access to the asset class. So sorry for that really long thing, but I'll turn it over to an LP or someone else who wants to chat about this.
Any LP perspective? I'm curious if there's anybody who has anything to weigh in.
Laura, I feel like we've got you as the token LP.
No, I know, and I apologize because our check size is kind of a little bit too large for what's already happened, and so it's something that we're paying attention to. We would have to get comfortable with kind of all the structures and things Nikhil alluded to, but we haven't dug in just because it's not a fit for our current program. But I think it's definitely interesting thing we're monitoring. But I'm sorry, I don't have any amazing insights yet.
The quick math around Sahil's fund is he's got about $5 million a year to invest. And if you think about the average venture fund as being invested over 3 years, roughly half of the fund being deployed towards new investments, half of it for reserves. Having $5 million per year, $15 million over 3 years is kind of like having a $30 million fund. He raised it in a couple of months through a few tweets. Now, I saw today there's some back and forth around was that legal and did it comply with SEC rules? And I don't have enough insight on that, but it's going to be something really interesting to watch. Did that answer the question, by the way? Or was that too much of a round?
That's right. Yeah, I was about to throw in a follow-up that you just mentioned that, this might risk the regulatory challenges which might come, later on, because I think one of the most interesting parts about rolling venture funds is that right now it may be a $5 million sort of a commitment for the year, but he can scale it up or down in coming quarters anytime. So that is pretty fascinating.
Does anybody know if they have, are there usually like reserve models associated with rolling funds or how that works?
That's one of the things that, is unique about this, which is, no, I mean, the reserve model is up to the manager to sort of figure out. And very likely you're going to have a different set of LPs invest in follow-on rounds versus in the initial rounds, and there's going to be all sorts of complicated stuff that you just don't deal with with the traditional fund model. But maybe it's actually going to be better for both sides. We're just going to have to see.
Yeah, it seems to me something like almost like an easy way to try things without getting fully committed to a career as a venture capitalist. In the same way that like. A tweet is an easy way to figure out if you want to write a blog post. It's an easy way to figure out if you want to write a book.
My only pushback on that is you are taking commitments. I think they're requiring LPs to commit for 8 quarters. You're investing in these companies, and these are, I mean, by definition, are in our industry long-term commitments. So I think the reason, if this doesn't work out, it will be because people treat it as a hobby. And I do think it's really important if you're going to invest in early stage companies that the commitment is serious.
I certainly don't want to get you committed to any position, but if you were looking at your future, would this be something that would be interesting, or is it kind of like you think that it's too far afield of stuff that would be worth exploring?
Yeah, I'm definitely watching it, and I've chatted a bunch to the AngelList team about it. And Sunil Pai at AngelList, who runs this rolling fund program, said there probably couldn't have been a better thing to have happen than my blog post about the solar capitalist. So at the very least, I think that I've helped a few people. I mean, Sahil, has messaged me a bunch of times saying that was very helpful to his fundraise. So, in a weird way.
That your blog post was helpful to his fundraise.
Oh, yeah.
Oh, awesome. That's great.
And so if we take it back to the writing, I think, that there is something about this series that has already led to some interesting outcomes for people, which is exciting.
I was gonna say real quick that I'm also very inspired by that, and I'm a founder. I've been thinking about angel investing. I have a gorgeous anti-portfolio since 2015. The hindsight capital is giving amazing returns in order of billions. But I'm inspired, and I've been thinking about maybe allocating a little bit of capital as an angel investor, or becoming an LP, or maybe starting off my microfund. And as a joke, I registered registered a domain. So I'm building a company called Puma Browser, but I registered a joking domain of puma.vc for video conferencing initially, but maybe it should be a microfund. And so as a founder, again, I also see, going back slightly to the question of what's opening in the market for investors, I think early capital is still very open. I think I'm part of the On Deck community of founders, and that's been amazing. I think they're doing something special there. But I didn't grow up here. I'm from Ukraine originally. I'm also Canadian. I didn't go to fancy universities. And so I feel like there's still an opening for very early first checks for people who are kind of like outside the traditional Silicon Valley mold. And I'm a pretty quick learner. I'm starting to learn who are the key players in the ecosystem, how it works. So there's probably even more maybe two-step opening. One is super early, betting on kind of like outside geographies or experiences. And second one is helping those companies raise the next round in Silicon Valley, given your network. I don't know if that's kind of like on the roadmap for your fund, but knowing everybody in the Valley is an incredibly valuable position to be in, to help understand the dynamics and help bridge the gap of helping raise next rounds. Because early stage capital throughout the world is starting to kind of work, but I think the biggest gap might be this like seed, as you mentioned, seed to Series A journey. Because after that, it's all spreadsheets. You put the spreadsheets on the table, people wire you money, things kind of work out. But this transition from that, I'm curious what you like for your particular focus. Is it going to be that, or are you going to try to go super early stage and catch folks super early on?
Yeah, it's a great point. I love the Puma VC name as well. I think you're absolutely right that founders from non-traditional backgrounds, founders who are outsiders on a bunch of different dimensions, that is a place where there should be more capital. And I certainly hope to be a part of that as well.
Vineet, do you want to jump in with your question? Thought it was a good one on this point. Solo capitalist territory. I can also read it.
No, I'm in a noisy space. That's awesome.
Everyone wants me to read their question.
Let me just read it out. So yeah, let's say solo capitalists become the model in VC. Yeah, it's a great question. How do VCs hone their chops being solo? I think one of the great things about the ecosystem is that there's a lot of peer mentorship. It's not just mentor-mentee at different levels inside of a firm, one person working for the other, that leads to learning and apprenticeship. There's a ton of peer mentorship. I mean, I've learned a ton from Katie, from Julia. I'm trying to look at who else is here. Who I've chatted with on a regular basis, and actually, even in that solo capitalist group that I highlighted, Lockie Groom and Josh Buckley live together. They literally live together and they talk about stuff all the time, and they both have their own funds, and so I think that there will be ways like that, but I think it's a good point because it is different. And it's different to suddenly have to start deploying capital. I think I benefited from growing up within two different institutions and seeing how investors who had seen much more than me did things, and to learn from them. And I feel very grateful for that journey. I think I wouldn't have the level of confidence that some others have today who haven't had that journey and are just deploying capital.
Follow up to this, actually. Do you think someone's first foray into VC can be as a solo capitalist?
Yeah, I mean, it's happening right now. I think you have to have an angle around find, decide, win. Those are different muscles than any other job. And I do think it takes some repetitions to build. But we're seeing the experiments right now with Lockie, Groom, and Josh, and a bunch of these people, who are foraying into VC as a solo capitalist first. I think most have made some investments before raising a fund. Most have have made angel investments. Katie, for instance, before she started her firm Moxie, had made. Well, Katie, you can tell us how many investments you made before.
40.
Yeah. And then people like Julia, who's an active angel investor. I think she's building that muscle right now, and it's going to serve her really well, whether she, whatever path she goes down.
It's interesting. Oh, go ahead.
I was just saying, Julia or Katie, do you want to say anything about kind of mentorship, having not been in firms?
I think for me, the best way to really learn is just by doing it. And I think Nikhil is spot on that there's a lot of just cross-pollination that goes on in this industry. And I learn something every day from a founder or from another co-investor. So I think that will continue to evolve, and it's just finding the best and the brightest and the ones that really are just aligned with your values. That's just going to help you get to the next level.
Yeah, I would echo that. I've mostly had sort of peer mentorship. Nikhil and I were just talking through a couple companies yesterday. What's I've found most helpful is to talk very specifically about an individual company with one other person and really go deep together and brainstorm. And that's something that as an individual angel investor, it's not as easy to come by. I don't work with a team, right? So I do think that there is something to be said for mentorship. I would love more of it from more experienced investors. I would love to be in the room on, the Monday meetings that go on and how decisions get made. Maybe that's the future of, who can be the next cool VC firm. They let people dial into their calls or something. Everyone's coming up with their new content strategies, right, in this remote world. So a lot of peer mentorship. I have VCs that will reach out just to have connections to angels and things like that. But I actually haven't found that they have much to offer me. They're a lot more what are you looking at? And for anyone who is giving me a little bit of mentorship as hey, here's how I think about stuff, that is a person I would love to establish more of a relationship with. But I'm surprised that hasn't happened as much for me as I would hope for.
It's interesting on the decision-making side. It does seem like those mentorship relationships do end up emerging kind of under, they're not always so visible. You don't see people on Twitter talking, but you have Slack groups and WhatsApps, and there's really strong networks of, small groups that do exist kind of under the, under the, forest of visibility, beneath the trees. So. I think those, like you mentioned, was it Lockie and Josh are roommates, and it's probably no coincidence that they end up working together in that way. I feel like I see examples of this kind of thing in private all the time. A lot of that going on. How and where do I sign up for these Slack groups is a question. I think it is. We'll have to host a virtual GP meeting on Highlighter Live, and we can get all the GPs in talking about kind of analysis of an investment.
It is an interesting point, though. I always think about, DK, with your decision-making point, how solo GPs think about possibly losing some decision-making discipline. You gain a lot of efficiency, right? But you don't have people, you're not selling as much, but then you also don't have people actively pushing back on you with skin in the game, getting carry off of your deals. So I wonder how solo GPs kind of manage that and still maintain a robust decision-making process and make sure that the peer-to-peer deal discussion that's going on is up to the same level of pushback.
At the smaller scale, the angel and seed scale, I think the collaborative nature of it makes it so it's easy for everybody to play together and actually works better. But I wonder, Nikhil, as you look at, you sort of define solo capitalists, is the model of ownership and sharp elbows versus collaboration, is that still being worked out, or are there general patterns that you already see emerge? Because I think of Series A as kind of a pitch point. There's only so many shares going to be sold, and it's usually if a traditional venture firm is coming in, that's probably the most competitive place to try to buy all the shares. And so with solo capitalists somewhat playing that role, do they have similar dynamics, or do they end up being more collaborative on those same types of rounds?
Well, I think part of the driving force behind the post is, you know, we started seeing these individuals lead rounds and, you know, directly compete against great firms where the firms were trying to buy 15, 20, 25% ownership, and where these solo capitalists ended up getting to, you know, maybe not the same level quite, but pretty close, you know, maybe to 15% ownership or 13% ownership or something like that. And so, you know, I think they are collaborative. There are rounds happening with multiple of them, but because they're raising these bigger funds, it's harder the bigger your fund is to be collaborative. You just naturally have to own more of companies to make the math work. Mm-hmm. And so I think you're seeing them be more zero-sum. That's kind of what's fascinating about it. Laura, go ahead.
Yeah, that was so fascinating to me too, because if you're leading rounds and your fund sizes are bigger, you want some diversifications. You need to invest in enough companies, but then if you're taking boards, like how many boards can you handle? Like, I'm just curious, it seems to work so much better at seed than at Series A. It'll be really interesting to see how it plays out.
And the interesting thing about that, Laura, is, you know, a lot of them are not taking board seats. So then you have something else, which is a company that's raised tens of millions of dollars, is post to Series A, but has no board and has no board governance. And that feels worrying to me. So anyway, I'm curious, actually, I just realized, so Mishi, who's at Highlighter, used to be in the LP seat, and she was at Princeton's endowment. And I feel like I haven't put her on the spot yet. An LP, an LP hat. So I'm curious, you know, if there's a question in here that you want to take a stab at answering, or some perspective that we may have missed.
Yeah, it's interesting because there's so many different flavors of LPs. So like at the Princeton endowment, some of these things were definitely like flags for us. For example, investing with a solo capitalist had a really, really high bar because there's just so much key man risk there. And also there's a lot of ops due diligence that goes on before the endowment invests in a fund. And that adds another layer of risk when it's just a solo GP. So for all of the gains that seem really appealing, probably for a lot of LPs, I think for other LPs, like where I was coming from, there are these like major flags that either someone's brand needs to be so stellar and like deal flow needs to be so stellar that that's enough of a reason to invest with them. But it is kind of like the odds are kind of against you if you're in that situation, fundraising. And yeah, the agglomerators and super agglomerators point was also interesting because I think that LPs like of a certain kind are also kind of driven away by the thought of having these massive funds with like everyone wants to raise a new opportunity fund and there's more management fee on top of that, and kind of just spreading out strategy and geography and fund size so much also being another red flag. So I guess like both ends of the spectrum have some problematic aspects that like firms that are raising would need to think through. I don't know how the other LPs feel or like what kinds of institutions they're coming from.
So Nate and I invest on behalf of Sapphire. So we're all venture, early stage venture in the US, Europe, and Israel. And it's really interesting because we now love solo capitalists. Mm-hmm. Definitely balance them with other groups, but like to Nikhil's point, there's no issues with transition. There's the bus issue that doesn't happen that frequently. Someone gets hit by a bus, but there's no decision-making issues or generational transitions. And you can really see if that person's background, what they've invested in, what they're trying to do. But we just haven't done it for later than seed and that's why I think Nikhil's article is so fascinating. What's happening in the market is so fascinating that we're definitely paying attention. And it's interesting too, because I just feel like a lot of times LPs, not all of them, but some of them, you know, take a while to get comfortable with a group, and then you can't avoid these big platforms. Like if you need to see a lot of traction and a group is doing really well, with the exception of Union Square and Benchmark, they grow their funds. So then you are left in that kind of, if you're an LP that doesn't invest in emerging managers and needs to see a long track record, the options have been more limited. So it's really interesting. And there are a lot of different LPs, to your point.
Thought I might chime in too. It reminds me a little bit of the Bezos, like your margin is my opportunity, where if you had a group of 5 investors at a firm together running after, let's say, I don't know, 5 amazing companies, and then you have one person over here running after these 5 amazing companies and they're going head to head, like it's much more efficient to be solo. Granted, I think there are problems that come along with that, governance, you know, to Nikhil's point about like people not showing up on boards, like that's a problem. Those will need to be solved, but it is a much more efficient way to go about doing things.
I wonder, Laura, you mentioned that you're sort of starting to be more excited about this kind of stuff. Is that because, has there been like a structural change recently, or just that you're seeing more of it, so it's more exciting because of that?
Yeah, I think there's a couple of reasons. One is it has become more popular in the last couple of years. I mean, it was there before, but more popular probably. And then just from our organization standpoint, my investment platform started in 2012. And we started as a Series A platform. So we've expanded, but some of it's just our history tied in with the ecosystem. But I think as you kind of pay attention to firms and fund sizes growing, there is just something beautiful about knowing exactly who's making the decisions and investing the capital and exactly how aligned they are. And that can be really attractive and complement other groups in your portfolio.
Great, thank you.
Yeah, I want to bring George in. Actually, George had a question about kind of where people are going to be pushing the envelope on innovation. Do you want to ask?
Yeah. So as a non-VC, but as a product person, I think a lot about like how do you 10x things, right? So I really like your analogy, Nikhil, about like venture capital as a product, especially in the context of that framework, the 5-step framework you have, right? So I think a lot about like, it seems like a lot of venture capital, if you think about it as a product, the product aims to differentiate primarily based on relationships, expertise, and brand, right? And one question I'd have is like, are there ways to 10x that, not just competing on relationships, expertise, and brand? For example, I'll throw out a couple of thought starters in terms of areas I thought were super interesting. One is like ICOs as an alternative way of fundraising, right? As an entrepreneur, if I can essentially launch a successful ICO, not only do I get capital, I also get an instant community of people who are bought into the success of my product. That's like pretty interesting, right? Second is like you see folks like Signalfire as well as Code2 doubling down in a really, really deep way on data science, right? And really using data as a part, I'm guessing, of the investing process. And there are probably other examples. I think early back in the day, Andreessen, when they were launching their fund, aiming to bring in additional value-added services, I think was probably a pretty big change, although I don't have very much context on that history. But if you think about this as a product, VC as a product, and you think about ways that we can 10x what the product does, or 10x, like, you know, to make the product 10x better, what are the different dimensions that you think we can really push on?
Really good question. You know, so certainly what you've seen happen in the industry is people try to 10x on the find piece by either, you know, scaling up massively in people or by trying to use data. And by the way, I'm skeptical that the data piece has actually led to a significant advantage for anyone yet, but it may in like a 20-year time frame. And certainly if someone from Signalfire or another firm that leveraged it were in the room, they would disagree with me on that.
Do you think they would disagree because they'd say it helps with the decide or helps with the find or helps with kind of everything?
I think different ones would say, you know, find, decide, or both. And then you know, DK brings up a good point, which is, you know, data used on the decide piece. You know, you could envision, you know, a 10xing of decide, you know, using data. You know, GB has some sort of black box that they input every company into. There are other firms that have that sort of put companies through an algorithm. You know, on the win piece to 10x, I think you really have to, if you go to the post about founder investor fit, what you are sort of saying is you're going to find it in every single instance, by 10xing the win piece. And so I don't exactly know what that means. I think it means a combination of having more people on the team. It could mean also just being a mass collaborator. Like you could argue SV Angel was 10x on the win piece because they just wrote small checks into everything. And then I think you're right, 10x on the help piece. Firms like Andreessen Horowitz and others, first round, for instance, have tried to do in differentiated ways. Like no one's really tried perhaps to 10x on the exit piece. So that could be somewhere that's more open. Maybe
that's SPACs.
Well, yeah, but
I'm kidding.
but I'm trying to you could hire sort of you could really focus on exiting your companies from day one, and sort of I don't know, that's maybe a contrarian view, and maybe there's a firm out there that's already doing this that I don't know about.
I think some of the larger platforms have like strong capital markets relationships as well as kind of large company relationships. I think there's some of that, but I don't know that I hear too many that sell on that idea.
So I think most of the big firms believe that the most important thing to 10x is win. So I think if you talk to folks at Lightspeed, for instance, they would say the thing that we are most focused on is winning, because we have an army of people, we're finding everything. There's enough signal around the decision based on who else is looking at it and how competitive it is and stuff. And we can help with a bunch of us. So it's all about the win. My perspective is a little bit different, which is I think still the opportunity is around the decide piece. That is, I think, still the hardest part of our business. And if you talk to any venture capitalist, they will have all seen more than enough companies in their venture career to have been one of the greatest of all time venture investors, right? And most of them, it wasn't that they lost, Google or Tesla or, Shopify or name whatever company. It's because they didn't decide to invest. And so I think that that's the single greatest opportunity to figure out how to 10x. I don't have the answer, but that's just my opinion.
I have a proposal that I've heard, and I'd love to hear your feedback on it, because I haven't heard it talked about much. So, the decide piece, I think most of the hypotheses end up being around better human process or better kind of data process. But I've also heard a proposal for a new approach to a venture firm building, which would be deeply focused on the decide piece, and so focused, in fact, that they would write up a very kind of detailed analysis of each meeting, and probably with a support staff. But they would be known as the place that does the best diligence and actually hands that back to the entrepreneur. And so it has a nice feedback loop that if you spend the time and you're willing to write it all up, you actually improve your own decide process, and you also have feedback into additional kind of find.
And you have a better chance potentially at winning. I mean, I have used this myself in a number of instances where I've been extremely transparent with the founder on, hey, here are my questions. I send the memo that I wrote to the team unedited. It includes stuff in the risk section, like, I'm not sure this founder can hire well. And so I've tried to leverage that too. I think there are firms that have done all sorts of interesting things on the decide front. First round, for instance, has a setup where each partner inputs into a system their own independent thought about a company before the partnership debriefs. And they found that helps to eliminate some bias. And they've gone back and looked at that data over time to see where individual partners spike and where they get things right, where they get things wrong. And so I think like some of the magic of our business is in that decision piece, and a lot of the magic of the business is in that.
How do you think about that personally? Like, how do you kind of look at your decision-making process and think about improving it in the future?
Yeah, I mean, I obsess over it. First of all, like I have all these different sort of internal tests of my conviction. You know, am I going to sleep thinking about it? Am I waking up thinking about it? How easy is the blog post to write about making the investment? How easy is the memo to write? Um, uh, you know, am I so excited that I want to flex on valuation? There are all these little things that I've kind of built into my process to try to figure that out. I also take pretty religious notes on every company on what I like, what are my questions / concerns, and then what's kind of the net. And so I've gone back and tried to study that to understand, okay, what did I get right? What did I get wrong in sort of good and bad decisions? But I do think that there's a way to potentially, use all of that unstructured data as a firm in the decision, and that's something I'm quite passionate about.
It's just Tarek here. I'm a founder and CEO at a company based in London. What's interesting is that you said you look for feelings to decide, as opposed to anything objective that you can point to in an investment. If the default state from a decision-making process is a no, and if you're looking at 100 deals, you're saying 99 no's, and if you're scaling up the find process, you're going to be saying even more no's. So if it boils down to feelings, so what you're saying is, how do you scale that? I don't think there's a product solution. As a product person, this is pretty annoying to say, but I don't think there's a product solution to this. It's more of an emotional solution to this, and figuring out the emotional reaction to a deal. And so if you're going to scale that with data, which is interesting, because you said all of the pointers that you got to were feelings, and first round was pointing to an objective analysis. And I don't know if you can point to an angel investment or a deal that you've done. You said, here are 3 reasons as to why I did that deal. If it's a great team, great product, great market, then everybody would be in that deal. But no, all the big deals that came out, like when the big exits that happened, usually don't have these characteristics. When John Doerr put money into Google, they didn't have any of these things. And so so how do you, given this fact, how do you scale? And if does that question make sense?
Yeah, you said a lot of really insightful stuff there, particularly for it being like 2:15 in the morning or whatever. Let me try to unpack it a little bit. So I do fundamentally believe so much of the decision making in our business is about humans. It's about one's perspective on a human on the other side of the table as a founder, and kind of the human feeling that you have as an investor. I think if you talk to Sir Michael Moritz, who maybe is the greatest ever, if you ask him about his investments in Stripe and Instacart, what's so fascinating is he also backed the previous instantiations of both those companies, Webvan and PayPal. And he would say, it was just all about the founders in all of those investment decisions. The market was kind of the table stakes excitement around it, but it was about the founders. And so that's what's so difficult about our business to scale, is so much of it is people driven at the end of the day. And that's why there are a whole bunch of objective things that I do look at, but what is hard is not what is objective and what is factual. What is hard is what is human and what is subjective and what is more feelings based, intuition based when it comes to the decision.
I think that's probably why the solo GP model works really well at the pre-seed and seed stage, because at the end of the day, you can connect with a single person a lot stronger than you can with a panel of VCs. And for some context on why I'm up, I'm literally in the middle of closing my Series A, and our lawyers are based in SF, and I literally I'm running on an SF timeline, which is why. So interestingly, I saw this link on Twitter and I thought, okay, I'm dealing with VCs. Let me jump on this call with more VCs in them. So, but I'm glad I did. This has been super interesting. There's loads of stuff. Like I can tell you when I did my pre-seed round, there's no team, there's no product, and we ended up closing a $3.5 million pre-seed round. I can tell you none of the decisions that the 9 angels that ended up coming on board were objective, like zero. So they immediately had a feeling and they said yes. I'm like, what are you saying yes to? Like, do you know where this is what's going to happen to your money? So having seen that decision-making process, where mostly it's about feelings, it's about what do you immediately think about something. The more you ponder over a seed investment, I've seen the people who say, let me have a think about it. There's like a 0% chance of them coming back with a yes, because they're probably looking at the next 10 deals. And if they haven't gotten past that friction point of saying yes, then they're never going to come back. And so in the solo GP model, which and I deal with loads of those people on my cap table now. If you think through scaling that, is it the SV angel model that really works, where they literally say yes to everything? So they use the network as a filter, and if somebody is able to pierce that highly selective network, they basically say that's the signal. So in the absence of that high quality filter around this GP, what's an alternative signal? If that makes sense.
Well, it depends on your. So first of all, again, a bunch of really insightful stuff there, and thank you for sharing, and congrats on closing up your Series A. I think on the solo GP front, it just depends on your strategy, right? So there's a few of these folks who are making very concentrated bets in only a handful of companies every year, and their mental model, I've spoken to a few of them, their mental model is like, yeah, they basically say no to everything, and they just wait for like those couple meetings per year where they get so excited they feel like they have to do it. And so they just have a different strategy and a different filter and a different bar.
You're able to dig into what the quality of those meetings were like? Like when you say yes, what drives those yeses?
Yeah, I mean, I've had this a little bit as well, because, you know, I haven't made that many investments. You know, at Shasta, I was part of, I think, 22 investments or something across 7 years. So, you know, an average of 3 a year or something like that. And so for me, with a more concentrated, you know, higher ownership strategy, I found myself saying no to a lot of things that I liked but didn't love. And one of the things I've learned over the years is that a lot of companies fall into the gray area, where they're interesting, where you like a whole bunch of elements of it, but for one small reason or another, you don't quite get there. And what I'm trying to get better at is just passing more quickly on those companies. But, you know, that doesn't mean that, you know, I haven't got a ton of stuff wrong. I mean, I've gone back and thought about so many of decisions, you know, having Robinhood come and present to our partnership, Plaid come and present, like all of these haunt me still. So anyway.
Well, it's great. It's great. You know, I think it's just the nature of the business to be able to see so much great stuff. And I want to start to bring us to closure. So we are going to wrap pretty soon. But first, I've got a few announcements. Then I've got a final question for Nikhil. So first, I just want to thank everybody. So Nikhil, thank you so much for coming and for all of your thoughts and insight here. It's been great, both the writing on the pieces as well as kind of showing up tonight and bringing your A game. Really appreciate that.
Thanks. Thanks for having me, and thanks everyone for joining.
Yep. And thanks to everybody who joined. I do want to mention that you can stay tuned for future town halls on the highlighter.com/discover page. And given how much focus we had today on decision-making process, it's actually really relevant. So everybody who's thinking about the decide part of Nikhil's flowchart, we have an author famous for decision-making who's joining us for her book launch in September. And that is Annie Duke, and the book is called How to Decide. So be sure to come for that one. We're going to have some other ones going on before then, but that one's already kind of announced, and you can RSVP for tonight. And I think we'll have the link in the chat right now. And so I want to conclude with a question, and it's not a question that we're going to answer, but it's a special opportunity we like to take to turn the tables. And so we've spent all of tonight asking you questions, and now it's time for you to ask us and the broader world a question. So we'd love to hear kind of what's top of mind for you, and what are you most curious about? And we're not going to hang around and answer them necessarily. We can talk about it on the highlighter page. We can, we've got a bunch of great questions that came in on chat today. So we will make sure that we can get those on the highlighter page and still keep following up. But we want to open it to hear just from you, what is it that you're most curious about?
Well, given especially what we just spent a bunch of this last period of the conversation chatting about, I'm thinking a lot right now about decision making. And so, I think if you look at life as ultimately a set of choices, there's a great graduation speech by Jeff Bezos in 2010, coincidentally at Princeton Baccalaureate, and where he talks about life being this set of choices, and ultimately when you look back at your choice, what you remember at your life, what you remember are the choices that you made. And so how do you make the right choices, the right decisions, the maximum number of times in your life is in some ways like this sort of ever fascinating thing that I keep thinking about. It applies to my work, it applies to my personal life, it sort of applies to everything. And so I guess I'll be trying to answer that question for my life.
Great. Well, thank you again for joining us, Nikhil. We hope that we can all make better decisions together, and be sure to join us for the town hall with Annie Duke, because I'm sure we can jam with her on that too.
Sounds good. Okay. Thanks, everyone.
Thanks
Have
much.
a good night, morning, etc. Thank you so much.
All right. Bye-bye.
Bye.